my clients that are looking are not only people fleeing Manhattan, Hoboken, and Jersey City, but they are residents in Jersey that would have stayed in their houses forever, but now have to look for a bigger one because both husband and wife need a ample workspace environment for their entire life. Makes you want to fly, big side cattle high.
Hello everyone, welcome to the Clear Path Podcast. I'm John Williams, and today I'm joined by Mike Farrell. Mike is a real estate agent in North Jersey. Tons of experience, a lot of really great insight into what really is just an insane residential real estate market. Lots going on, interest rates going up, supply is low, demand is high, and it's really just making it a very difficult market for those really who are on the buyer and the seller side for a lot of different reasons. So today we're going to unpack it all, try to give you some tips and some insight into some of the things you should be considering in today's crazy market. So without further ado, here is Mike Farrell. Hello everyone, welcome to episode 6 of Clear Path Podcast. I'm joined today by Mike Farrell. Mike Farrell is not only a great and old friend of mine, but what I am calling today our resident real estate expert. I'm going to hand it over to him in just a second to have him tell us a little bit about his expertise and his experience. But today we're here to talk about, as you can imagine, buying a home and some of the let's call them environmental, I guess the uniqueness of the market today with interest rates and some of our clients that we're coming across that have some trepidation about getting into the market and some of the things that might be holding them back. We're hoping to clear up some of those things and really just shed some light on where we are today and where the market may be going. But Mike, thanks a lot for joining me today.
Hey, John, thanks for having me. Just a quick background on me. I started my real estate career in 2004 as a loan officer, which I really look back on fondly because it really helps me be able to help my clients financially to buy a house. I spent years as the person helping them obtain their mortgage in the best form of financing. And then I fell in love with real estate and kind of transitioned over to a full-time realtor.
And how long were you in the loan business until you decided you wanted to be
Yeah, so I
a
did that for
realtor?
about 3 years and then I didn't stop. But what I did do is I opened up my own real estate company because I found that most people didn't have the cash to buy the houses. So all of my clients needed financing. So it was kind of like a peanut butter and jelly type situation. I figured if I opened up a real estate company, I then could help buyers with financing, and it worked very well for years. And then only after I really started to fall more in love with the real estate side did I kind of just move away from financing. So I did both for many years.
Yeah. Was there a moment, do you remember, where you're like, where you said to yourself, okay, like I'm going to be a realtor? Like, was there something that happened or was
Yeah,
it more of a gradual kind of a,
what a great question. You're getting me to think of things that I didn't even realize. So I wanted to have a good, strong real estate company, right? So what did I do? I went out and I hired some of the top real estate coaches in the country to train my agents. And then I found that they would get excited for a little while, but weren't really implementing some of the great strategies that these trainers were putting forth. And I said, how am I going to have a good real estate company and lead them if I'm not a licensed realtor myself? Because I was still doing the mortgage end, and I was only licensed in the mortgage side, um, just to be RESPA compliant and stuff. So what I did was I went out and got my own license, and I led by example. I followed everything that these coaches told me to do. I started including my agents one-on-one to work as a team to show them how we can grow our businesses. And the next thing you know, just by doing that, I was a licensed agent and I enjoyed it and was doing very well.
yeah, that's really, I always just love to hear people's like story, because we all have those sliding door moments in our lives where we're just, and, it's interesting to look back on those things. So, in the thick of it with real estate right now, tell us a little bit about your business today.
So, yeah, business is a little more difficult than normal because of the shortage of inventory. So, we're still blessed with very low interest rates, although, the experts are saying they're going to start rising. So, that added to a little bit of a craze and a frenzy of people running out to get houses. But the pandemic is really the culprit for this. I think what we saw that most people didn't expect was everyone started fleeing Manhattan, Hoboken, and Jersey City during this pandemic because it's so densely populated. And let's face it, at the time when this came out, it was very scary. We had never experienced this in a lifetime. This virus and the potential death threat of it. So what it did to the real estate market, combined with very low interest rates, where people were running from Manhattan, Hoboken, and Jersey City. These were people that were mostly in the financial world, so they had the money to do so. Plus, if they sold anything in those areas, the money they got for a two-bedroom apartment in Jersey City could buy a 5,000 square foot house in northern New Jersey. So I think personally, that's what added to this low inventory because it got gobbled up and everything was selling in a week with multiple offers and things going well above list. In To give you examples, we're finding houses that were listed at 300,000 were going well over 350. Houses that were listed for 800,000 were going 875, 900, which I haven't seen prior in my 17 years in this industry.
Yeah, yeah, and it's interesting that like this pandemic has really just created an environment that we haven't seen before from so many different angles. It's amazing to me, like even in our work, like just it. I mean, I know it's kind of goes without saying in a way, but there's just so many unique factors that come from the pandemic. But just the mindset you said is you're in this like this situation you in that is just no one's even really talked about before. It's like it's
Right.
so different, and meanwhile you're worried about your family, and it just really it makes you reframe your life. We've seen a lot of that movement, and even real estate in parts of the country that were never even looked at, like the Poconos, for instance. Not to get
Right.
off on a certain area where people are all of a sudden like moving from the city into um, more rural areas. Like, and it's just this shift. But to think that people, there's anyone who's bought a house, and me being one over the last year, they hear these stories of what you were just saying of these houses being I don't want to call it overpriced, because the price is what the supply and demand obviously dictates. But I feel like there is this trepidation about getting into those bidding wars, and they feel like they're overpaying. And is there any thoughts on that, and like how that's have you seen that settle down? Is that something you feel like is something that people maybe are overplaying, or are over concerned with?
Well, it's funny, before I even answer that, you brought up another good factor that's really adding to this mass buying spree. That person that went from the city that now is looking to buy in the Poconos, the reason being is the whole world is going virtual. People that had careers of going 30, 40 years into Manhattan or just into an office can now work from home forever. So when this pandemic goes away, God willing, very soon, right? They're still working from home. So the people that lived in, hypothetically, I say this now because I live here, northern New Jersey, that didn't go to Manhattan, right? Now they're no longer going to an office. So their four-bedroom house that was great for their family when the husband and wife went to work is no longer big enough. They're now scrambling to get houses, and some are looking in the Poconos where it's cheaper so they can get a bigger house. But that's another thing I don't think experts really anticipated because this pandemic rolled out and we were, I guess, just reacting to things that came our way. And one of the things is everything's going virtual. So a lot of my clients that are looking are not only people fleeing Manhattan, Hoboken, and Jersey City, but they are residents in Jersey that would have stayed in their houses forever, but now have to look for a bigger one because both husband and wife need a ample workspace environment for their entire job. So with that said, I only wanted to go back to that because now you're talking about a mass seller's market, right? There are way more buyers now because of those two factors. People fleeing from areas that were kind of a petri dish for health reasons, and now never going back to their office. Their home becomes their office. They need ample space. So, with that said, everything seems to be going over list. I don't think houses were priced too high, but they're selling a lot higher than we anticipated. Now, what you brought up is, what's the value of a house, right? It's not a can of corn. The value of a house is what someone's ready, willing, and able to pay. So they're valid prices because it's starting to increase, but there is trepidation, and rightfully so, when to get in on it. My feeling is this: the one thing you're battling, though, is interest rates. So if prices go up, but interest rates stay low, your monthly payment is really the only thing that matters, right? So if you could afford that, you want to get in sooner than later because prices can continue to rise and interest rates can continue to go up. If prices do settle and kind of level out a little bit, but interest rates rise, your monthly payment rises. So that's kind of the pressure that buyers feel today. They don't want to overpay, but you don't want to miss the boat either. And there's a lot of those variables that you can't help. So what I try to educate my buyers on are two things. Number one, where are you coming from? What's your necessity? Are you living at home and you have no real timeline to buy? Then my suggestion to you is, hey, look every day. And if you see something that fits what you need and the price seems right, jump on it, right? Because the very best houses sell the quickest. So you want to be always looking. If you're currently in a home, maybe you own it, and maybe you're that person that now is working from home and there's not enough space for you and your wife to adequately work from home. Well, now there's a little more of a need for a bigger house. And that would make more sense even if you have to get a little involved in a bidding war, right? You have a need. But if you're in a house and everything's fine, and let's say you're still going to your office or you have the space for an office, then I don't think there's really a need for you to get into this crazy bidding war. So it really depends on where are you coming from and what are you looking to achieve? Because you don't want to overpay, but you don't want to miss the boat either, especially with interest rates and the volatility thereof. And most people are saying they're going up.
Yeah, and I don't think people realize, the impact that an interest rate has on the total amount that you're actually paying out to for the house. It's just something as simple as 1 basis point or just a tenth of a percent. And to look at that, and was one of the things we try to do is educate our clients on understanding. Would look at just that quarter of a percent over the life of the house is way bigger than trying to save or waiting to get into an environment where there's not as many bidding wars going on, where you might be able to save $20,000-$50,000. Typically that higher interest rate, and obviously it depends on how much higher you're talking, is going to be way bigger than people realize.
Yeah.
Have you seen that, or like do you have those types of conversations with clients?
All the time. And I'm amazed at how clients don't realize that this is just math. It's not an opinion question, right? We could calculate what your monthly payment will be if you pay $50,000 more at today's interest rate versus 50,000 less if the interest rates went up a quarter or a half percent. So the other thing that I'm always amazed at is clients don't realize what a monthly payment will be or what they could afford. So, for example, first thing we do as a realtor when they want to go see houses, we say, hey, are you pre approved for a mortgage, right? And most of them are. If not, that's part of my job. I make sure they get in touch with a great lender that I've been using for years if they need a referral, or I help them along with their own lender and we get them pre approved. Once they're pre approved, or maybe they came to me pre approved, I always ask, you know, if you're pre-approved for $600,000, I always ask my clients, what does that calculate to be in a monthly payment to see if they know? And I would say, John, 99.9% of my buyers have no idea what the monthly payment is. So meaning they go to a lender, they give 2 years of tax returns, their last, 60-day pay stubs, 2 months bank statements. They go through the process and they get pre-approved. They make good money. They have good credit, and the lender says, "Okay, you're approved for 600,000." My point is, do you know what the monthly payment is on a $600,000 loan? Because if that's not what you're comfortable with, why are we looking at $600,000 houses, even though you could technically qualify for a mortgage? So I always start there with monthly payment. It kind of flips a light switch on in my clients where they now start realizing what's important. In a way, it doesn't even matter what you pay for the house. In a way, it doesn't really matter what your interest rate is. Combined is what matters. What is your monthly payment? Because if I overpay for a house, to your point, but the interest rate is 1%, I'll take that house before I lose it. If that house is perfect for me and my family, and I'm getting a 1% interest rate, I'm in. Because over the course of 10, 15, 20 years, that house is going to go up in value. Conversely, if I pay less for a house, but interest rates are back to double digits, which our parents have seen, that's going to stop my buying power. So I'm just amazed at how buyers never seem to know what their pre-approval correlates to in a monthly payment. If they're pre-approved for 1 million, what does that mean in a monthly payment? Pre-approved for 800,000, what does that mean? And I always start there, and it really helps us to make sure we get the house that not only fits their family aesthetically, but fits their financial family and their financial needs.
Yeah. And do you feel like more times than not they are underestimating what the monthly payment will be once everything is all said and
Yeah,
done with? Yeah.
yeah, because
And
even
that
when
the unfortunate part of that is like they could fall in love with a house that they
right.
can't afford.
But then we look at other things, right? Sometimes they'll just have to put a higher down payment down, right? Which they have, but they may have the money elsewhere, like with a financial advisor like yourself, and we'll weigh those options. What are your gains if you leave the money there versus the increase in monthly payment? But I think the biggest problem is even when their loan officer goes over a monthly payment, it really doesn't include everything that they have to do, right? The loan officer is going to tell you what they call PITI, principal, interest, taxes, and insurance. But that's not your heating bill, your gas bill, your cable bill, right? All the other things that go on in a home. It could be your cleaning bill. I mean, most people have, because husband and wife work, they'll have someone come in every 2 weeks to clean. That could be $300-$400 a month, right?
Yeah.
So I
Well,
try to go
do you
over
have enough
that.
furniture to fill the house too? I mean, because chances
Yeah,
are, in most cases, a lot of cases, people are buying a bigger house. Are you going to have like 4 or 5 rooms that are empty for
right.
3 or 4
You don't want
years?
people to have buyer's remorse. And I'm often surprised how ill-educated most buyers are on the entire expense of owning a house, even if they've owned it before. These are not first-time home buyers, but they might be buying a bigger house, and in most cases they are because of the things that we said with the pandemic, right? Now they need an office space. Now they're moving out of a two-bedroom apartment in Manhattan. They're getting bigger houses, and heating costs are something you have to factor in, right? Cleaning costs you have to factor in. You just do.
Yeah.
Um,
How much does um, the length of time that the buyer expects to be in the house going to play into the equation? And just to give you a little bit of um, just as an example, you have one client who says, "All right, this house is going to be a I don't want to call it stepping stone, but like a house we're going to be in for a few years. Chances are, we want to buy something 5 years down the road, as opposed to a family that says like this is our forever home and we can't see ourselves really moving or wanting to move because we're looking for that type of home that we love so much that we're really going to be in for a while until the kids go to college or whatever it may be."
Yeah, that's another great question. One of the biggest things that I find buyers never take into consideration is just that, how long they're going to be there in the sense of their mortgage. If you know you're going to be there between 5 and 7 years, 5 and 8 years, but you're not going to be there anywhere longer than 10, then you shouldn't get a 30-year fixed. You could save a lot of money with a 10-1 arm, which means it stays fixed for 10 years. There's a 7-1 arm, it stays fixed for 7 years. There's a 5-1 arm, it stays fixed for 5 years. And these interest rates are a lot lower than a 30-year fix. So I always try, because my background came from being a loan officer, I go over that with my clients because that makes a big difference. Now, I also tell them though, if you're not sure and you might be there 10 years, 15 years, 20 years, then at that point, you don't want to get caught with your loan going adjustable. But if you know, sometimes it's military people, or sometimes they literally their job is going to relocate them in 5 years, then you want to look at a 5 year arm, and you'll save a lot of money with that. And it still makes sense to buy versus rent because of the equity you could build, in that time frame. But we try to, I don't just try to sell houses to people, even though that's where I make my living. You gotta really analyze what their needs are. And in some cases, I've talked clients out of buying a house. I said, you should rent. If you're gonna be there 2, 3 years, rent right now, because there's closing costs involved. And then conversely, people that were renting never thought they could buy. They never really looked at what their monthly payment is. And next thing you know, they're paying rents that are just staggering. $3,000 a month rent, $3,500 a month rent, when they could be building their equity, and getting a tax shelter, really.
Yeah. Yeah, no, it is. I mean, look, at the end of the day, I do think it's a very emotional purchase. It's a big, obviously, for most people, the biggest purchase they're going to make. And I do think that it's hard to, make the math meet the emotion sometimes,
Right.
but like it is helpful to see the numbers and know what you're getting yourselves into, looking at the payments and, at a personal level for us, when we first started looking, we weren't looking for necessarily, I guess we were just looking.
Right, right,
And then there's danger in that, but we started
right.
to realize how, and we got lucky enough to find what we thought was going to be like a home that we're going to be in for, as far as we can see. And we could see the house that we saw we could really see our kids grow, us growing older in, and our kids going to school, great school district, and all those things. But my point is that, we, from that point on, as we started thinking about like maybe putting a little bit more into our offer, became less about like how much we were paying for it and more about what
Right.
the cash flow was, because it almost, we, like, to your point, we know we're very comfortable that the value of this house is going to be much higher than it is today, just because of our timeline. But we just want to be comfortable with, the cash flow of the household, and then, from there, our happiness and all those like utility type things that come into play, they're hard to put value on. So now that we're on the topic of the value of houses, have you seen a shift at all, or a drop in value, a rise in in inventory, or just anything moving in a different direction, or I dare to say better direction, but a different direction than you've seen over the last 3 to 6 months or even a year?
Yeah, things are starting to level out as far as buyer demand. We have not seen an increase of inventory as of yet, but that's normal because we're in January. So as February and March rolls around, that's when the inventory always increases, every year. But we have seen a little bit less of buyer demand, which I think is a good thing. I think, as a realtor, even just a buyer or seller, any true extreme is just a difficult market for everyone. So it's been an extreme seller's market the last year and a half or so, really since the pandemic, right? So we're almost going on 2 years. And now it's starting to, I guess, just taper back a little bit. It's still a seller's market without a doubt. But like I said, as we roll into February, early March, I think inventory is going to really start to increase, and it'll start to be a little bit more of an even market where there's a lot more inventory that people aren't fighting over the same exact house.
Yeah. And do you find that the new home buyer, or the first time home buyer, I should say, is it's a little harder for them to swallow the values of the houses because they're not selling something? Like, say for instance, like if you have a $300,000 house and you get what you consider to be 50% over market, or, I mean, obviously that those aren't the right words, but, and then you're buying a more expensive house, even though it might be bigger. Do you have those conversations? Is it kind of leveling itself out? Like if you have a home to sell because it might go for higher. I mean, obviously it depends also like where they're selling and buying and all those things, but do you feel like there is a little bit of relief when it comes to that?
100%. Again, if you're selling 200,000, you're buying 800,000, it might be a bigger gap. But if you're selling something and buying, those are the best clients right now and that are doing the best for themselves. because you're taking advantage of a high market when you sell and you're paying a little more when you buy, but you're getting what you want. The buyers that are either first time home buyers or have nothing to sell and were renting, maybe owned something in the past, it's harder because you're paying a higher price. But again, it goes back to your need, because if you are great where you are and you just feel like owning a home, well then I'd be careful. I would be cautious. I would look every day. I always urge my clients to look, because even in the toughest times, there are still good buys out there. You just never know someone's circumstance or just timing. I've had a client come in, put a full list offer in on a house, get it right away because the seller needed to move quickly. Whereas I know in my heart, if that seller just took more time, they would have gotten overlist. So my client was ecstatic, but it met the seller's needs. They needed someone quick. So always look. If you have something to sell, it's a lot less frightening because you're going to benefit from the strong seller's market, and it'll ease the pain when you go to buy. If you don't have something to sell and you're just buying, just make sure it makes sense. Make sure what you're buying is going to be there long term. If you're not going to be in this next purchase long term, then you may want to pause and really run some numbers before you get into buying something at the higher end of the market.
Yeah, no, that makes sense. And there is the pandemic is still going on, so that's in our minds. There's a lot of tension. It's really, I know there's really, really hard to work through these things, but it's really great advice. And even on top of that, if you really think about it, a lot of new home buyers grew up through 2008, right? And unfortunately, 2008. I mean, obviously, I'm not going to say it's not going to happen again, but it was such a unique experience to have like a bubble like that. And I've come across a lot of people who just they it's still fresh in their mind, right? Like that housing market, and everything that happened through there. And I think that like that shifts the conversation away from those fears. Is like, hey, look, even if 2008 happened tomorrow, again, the value of your house, if you know you're going to be in that house for 20 years, it's almost irrelevant. Obviously, you'd rather it not happen, but I think that that's really just kind of trying to shift those conversations away from like those fears. And obviously, they should always be considerations, but with that, and on the topic of first time home buyers, is there anything else aside from like some of these other, and maybe they are related, but some of these really media centric topics that we've been talking about? Is there anything that the first time home buyer or even the home buyer what they should be considering and thinking about in the beginning of the process? I think like a lot of things, taking the first step is sometimes the hardest because you just don't know if it's the right step, or you don't know where to go, you don't know where to start. Is there anything that you offer to somebody that say, hey, Mike, I'm thinking about buying a house, where should I start?
Okay, you brought up a lot of great points. Going back to 2008, if there's one thing we learned in anything in our lives is never say never. But I feel very confident about the housing industry because they really corrected the problems of 2008. And the mortgage meltdown was because everyone had adjustable rate mortgages, and in addition, had some of them had negative amortization mortgages. Which, if you haven't heard of that, you would pay your monthly payment on time, and you started at $300,000 balance, and you paid it on time for 3 years, and you owed more than 300,000 when you were done because you weren't even paying. Your minimum payment was lower than the interest they were charging. So the banks really were the villains in that, and the federal government did a great job and just removed all of those loans and put laws in place. So, with that said, going forward, could the value of houses crash? Yeah. But you know what I tell my buyers and just my clients in general, buyers, sellers, any homeowners, if you buy a house at 500,000 and you live there for 2 years, 3 years, 5 years, doesn't matter. And all of a sudden, the value goes from 500,000 to 200,000. That would be horrendous. But if you don't move and you don't sell the house, it doesn't affect you, right? If just because society or the government says, and not the government, but just the industry says, now your house is worth 200,000 based on what people want, but you don't move and you live there, did you lose any money? No, right? Same thing with a stock. If a stock goes down, but you don't sell it, and now you hold it for another 5, 10, 15 years, now the house goes from 200, passes your $500,000 purchase, and it's back to 800,000. So there's something to really understand about that. Don't sell for the sake of selling. Don't be cattle. Understand what the issue is. If someone's telling me on paper my house is worth less, that doesn't affect me. Same as I own a house right now that I bought in 1998 that's worth more than I paid for it. Listen, that's great. It warms me at night, but I don't have that money. So I'm not even realizing that gain because I didn't sell it. So on both
Mhm.
sides. So again, I'm saying this as a positive. Even if the housing market dips, if you could afford your mortgage payment, it doesn't affect you. Because I'll tell you this, and this is a Mike Farrell original. If you choose when to sell your house, you will never lose money, right? If you get nervous and you just, oh, we got to sell now, it's a fire sale, then you will. But if you hold on to it, it'll always go up. So, what do I do to answer your question with my clients? The only difference I have as far as handling a first time home buyer or an experienced home buyer is payment shock. The first time home buyer, and we talked a little bit about this already, does not realize all of the other expenses, right? They go to a mortgage person, they have a good job, they have a good credit, they put money away, they're doing everything right. And they look at that pity payment, principal, interest, taxes, and insurance, and they go, I got this. But no one really told them their cable bill could be $200 just to watch TV, right? Internet, their heating bill. They don't go over that. So that's what I do differently. I just make sure, and oftentimes, believe it or not, I just take out my bills. I bring my bills and I say, well, listen, my house is here and this is the size of the house. But just to give you an example, like you may not have seen that. And it's not until they look at a PSE&G bill that they kind of resonate. And we'll say, like, listen, you're buying a house half the size, it could probably be less, but I want you to really incorporate these bills. And now, what do you feel comfortable buying? Once we have one conversation, we're up and running. It's not a negative thing. They go, oh, glad you told me that. You know what? I'm approved for 800, but I'm not going over seven. And I go, okay, great. And we get them a great house at 700,000. And guess what? They have no buyer's remorse. They're happy as a clam because, again, they're still putting into their 401k. They're not eating soup every week because they're house poor. That's what we want to make sure we avoid. You don't want someone to be house poor. You buy the greatest house in the world, you love it, but the bills are overwhelming. That's not a good situation to be in. So that's what I try to concentrate on. Total bills and payment shock. And payment shock is when you're not used to having a house, right? You're paying rent for 2,500. Now they're telling you the mortgage is going to be 27. You go, oh, that's no big deal, 200. But you factor in all those other costs. Next, you know, you're at 3,500, and you didn't expect that.
Do you find there's a rule of thumb when it comes to those? Because you might, from the outside looking in and without having experience with it, you could still maybe look at those things and be like, oh, that seems doable, you know? But when you're really in it, um, it might be different. Is there like a rule of thumb? You say, hey, look,
Yeah,
this is your paycheck. Like, you know, you want to stay below this percentage on whether it's the value of the house or like let's say you have that total number with your bills and everything. Like, I mean, obviously you don't want to tell people how to live their lives, but
right, right.
is there something that you found that just in your experience, like getting feedback after the fact where people are like, this was just a little too much?
Well, it's funny. The first baseline that I have is just what mortgage lenders do to approve you, right? Most underwriting guidelines will say they don't want you going over 43% of your income for your mortgage payment, right?
For your
Um,
short-term liabilities, you mean? Or like
yeah,
what
I'm
you
sorry,
owe.
your back end ratio, your debt to income ratio,
Debt
DTI.
convention. Yeah, yeah.
Yeah, so that would be like 43% of your gross income. They want to make sure
Mm-hmm.
you don't exceed that with your other liabilities that are on your credit report, your car payment, your credit cards, student loan installments, which is a really good rule of thumb because let's face it, your electric bill is not on your credit report. So there's going to be other bills, and that's why they keep it so low. So I think they've really done such a great change in financing that it kind of really helps all buyers today. If you go back to 2007, 2008, they had 100% financing for stated income. That means if I had a salary job, but my numbers didn't work out, and I just stated that I made 100,000 more than I did, they gave me the loan and they gave me 100% financing, which means I didn't have to put any down payment. So that's why we totally had a housing meltdown because people shouldn't have had houses that did. Now, again, to your question is, yeah, you kind of want to stay, 40%, 43% of your gross paycheck shouldn't exceed your bills, your mortgage payment with your tax and insurance, with your car payment, with your credit card payment, with your student loan if you have it, because you then have to put away for retirement. There's all these other bills. And if you stick to that, you'll be fine. You'll be fine.
And they're using that number basically to back into the pre-approval number. And so like if you're making your gross $10,000 a month, if the number, let's call it even 40% is $4,000, they're going to then use that payment, take the interest rate, and then back into like a lump sum from the interest rate that they're probably going to be able to offer you, and kind of come up
Or
with
they'll
that
just
pre-approval
approve you for that
number.
loan. Remember, you're going to them with it. So you're saying, hey, I just found a house. It's, $800,000. I'm putting 20% down. My mortgage is X. And if they say, okay, based on that and what you qualify for an interest rate, your payment cannot exceed $4,000 in your example. If you make 10,000 or 4,300 really, because they'll go to 43%. They'll say your mortgage plus your taxes plus your insurance plus your car payment or payments, husband and wife, right? You may have multiple lease payments or car payments plus your student debt. Anything that's on your credit report cannot exceed 4,300. If it does exceed it, you don't get approved for that mortgage. And in which case, you have to buy a house that's less expensive or come up with a little more money to reduce your mortgage amount.
Real estate
What?
taxes are involved and included in that too, right? So that's
Yeah,
obviously
pity.
effect.
Principal,
Yeah,
interest,
yeah,
taxes, and homeowners insurance. And when I say taxes, real estate taxes, sure.
yeah.
Yeah, property
And
taxes.
in New Jersey, which is a really a big factor, which might be a whole nother episode. Um, but yeah, I mean I feel like that's, it sounds like the in a good way the and again I actually bought myself in 2005. The funny thing is then, like, I remember refinancing. um I refinanced like 3 times. I think I started like 6.5 and went down to five. I went down to like 5.5, and then it was like there was like this refinance. That On that topic, like, in thinking about interest rates and how they've moved, even at 3.5, people are like, "Oh man, I missed out at 3.5." 3.5 is historically is amazing. Like, even if they
Amazing.
went up to 4.5, you're still. And I think part of that is like kind of, it's good and bad because we think about it, and we obviously that the opportunity was missed, but historically, I think we have that, or just over the past few years, we have that, like, hearing of people getting below 3% on our minds. So when we like get quoted the 3.5 or the 4, we're thinking about, oh my god, this is terrible. But interest rates may never go back to where
Right,
they were. Um,
right. But speaking of interest rates and loan officers uh, don't really do a good job of explaining this, and I think it's by design. And it's a shame because we really need to be honest with our clients, whatever industry you're in. And one of the things is this. So let's say you're at 5%, and now interest rates are 3.5. So you get bombarded by your lender, you get calls and letters. Hey, we could save you $3,000 a year. Now, I'm making these numbers up, but the point is, they're saying, yeah, we calculated it. We're going to save you $3,000 a year. Or better yet, they'll say, we'll save you $300 a month, right? And you go, wow. Now, are they lying? No, they are going to save you that money because it's math. However, they're misleading you because you may have 25 years left in your mortgage and they're resetting you to 30. So is the interest rate saving you 300 going from 5 to 3.5? Nope. Your saving, part of your savings is coming from resetting your clock to 30 years. So what I tell my clients, and I told my clients when I was a mortgage loan officer, and I lost transactions this way, but I didn't care because I want to be honest. If you want to calculate if there's a savings, you have to compare apples to apples on years. So for example, if you have 20 years left, when you refinance, go for a 20-year mortgage and get that estimate. You can't reset your clock because it's a fictitious savings.
Yeah, and I remember and like I usually use like this interest rate change. Like there was a range. I think it was about like 1%, or people say that it makes sense um, for you to refinance. And I don't know if that was just to cover the actual
Closing
costs or
costs?
the closing
Yeah.
costs, or but I don't hear a lot about people talking about the reset on that and what that really looks
Yeah.
like from a total number. And I wonder how many people like would are refinancing. With that said, like if how many people may have refinanced and maybe not made out in the long term, but if they did improve their cash flow and that was their main goal, then that would make sense. But is there is there something is that when you use like 1%, or do you say 1% and then you also have that second conversation as to look at what the total outlay is?
They say 1%, but I don't think there's any magic formula because 1% is nothing if your mortgage amount is 200,000. But 1% is a huge amount if it's an $800,000 mortgage. Whereas
Mm-hmm.
there's a lot of savings if you only save a half a percent or a quarter percent. So I try never to use a number like that because it's too easy for me to ascertain if it makes sense immediately. All I do is, hey, John, you're at 5% now. The current rate's 3.5. How many years you have left, right? Whatever it is. Now, they don't give mortgages for 22 years. So you are kind of victim or not victim. You're limited to 20-year mortgage or a 25-year mortgage, but we'll take the lower number and see if it makes sense. You never want to increase your years. So in a perfect world, you're at 25 years, we can get a 25-year mortgage. But if not, let's say if you had 22 years, I would look at a 20-year mortgage, which by the way gives you a lower interest rate. But if you can't save money going from 5% with 25 years left, going to 20 years at 3.5, right? Then I'd say don't refinance unless your only goal is cash flow. But remember, just to really illustrate what I'm talking about, I could save you. How much money you want to save on your mortgage, John? You want to save $1,000 a month? Wouldn't that be great? I could do it. I'm now going to give you an 80-year mortgage. But does that really help you? Right? Your mortgage payment's lower by $1,000. But at the end of the term, you now paid 5 times the amount for your house, right? Instead of like a little under two. So I just want clients, buyers and sellers to be aware of that. Compare apples to apples. It's a big kind of gray area in the refinance world that they're always, always championing that they're saving you money. And most of the time, they're saving you very little, if at all, right? The $200 savings a month, the $300 savings a month, it's all coming from resetting your clock to 30 years, not really going from 4.5 to 3.5.
Yeah, no, that's interesting. I think just running the numbers and doing a true amortization, you'd almost think there should be regulation that requires the mortgage industry to show the true difference in amortization and the total outlay because of that,
Well, you know what
because
they
it is
have now?
misleading.
Yeah, but they really put some great laws into place, John, because 2007, 2008 was horrendous for everyone. I mean, banks were going out of business. It wasn't that just homeowners were losing their houses. The banks were going out of business because no one was paying their mortgages. So one of the laws that they put in was benefit to borrower. There's a formula, and if you don't meet muster, you cannot provide that loan. Even though, to make sure I'm crystal clear what I'm saying, John, you go to refinance, your credit is perfect. You make stellar income. Your DTI, your debt to income ratio is low, meaning you yourself qualify for everything on every principle, right? Income, credit, your ability to repay. But if you don't pass the test of benefit to borrower, that lender is not allowed by law to give you that loan. And I think it was one of the best things that we put into place because we were giving people refinancing loans thinking they were helping them, and they weren't. All they were doing was stopping their ability to ever pay off their home by giving them a little bit of a savings, 100, 200, 250 a month, little breathing room, but just resetting their clock to 30 years again and again and again. And it's bad.
It's a really interesting point because there has been so much refinancing, and I guess that those regulations couldn't come out at a better time, before this big refinancing. boom has happened in lower interest rates, because I almost don't know anybody who didn't refinance who had had a loan over the last. I mean, when did this all start? I mean, we were thinking they've been low for a really long time, right?
Really long time. In
Yeah.
2004, when I started as a loan officer, rates were the first refi boom that I lived through. Rates went down to 6.5, six and a half
Yeah.
percent, and our phones lit up, and that was 2004. And now, if it ever went back to 6.5%, we'd go, "What? Oh my God!" But we forget. Our memory's short. This is
Mm-hmm.
2004. Our phones lit up, and we couldn't get to the people trying to refinance fast enough. Life was good back then, as far as being a loan officer, and that was 6.5 that we were offering. When it broke 5, I remember it being just as much of a boom. Again, people that were at 6.5 came back. And again, I don't necessarily think the savings is there. They just refinanced not that long ago, a year or two ago, and to go from 6.5 to 5 sounds good, but you have thousands of dollars worth of costs that get added to your balance. So your balance goes up even though your payment goes down a little bit. And it's kind of like a shell and mirrors game, or the shell game. Hey, look over here, don't look over here, look over here. And all they want, the loan officers and the banks want you to look at your new payment. But remember what I said. If I have a bottle of water and I say, "Hey John, you thirsty? This bottle of water is $10." You go, $10? I would never give you $10. I go, "Okay, John, you're right. That's not fair. How about you give me 50 cents a week for 10 years?" And you go, "Oh, 50 cents. I'm in. I could afford 50 cents." Right? But at the end of it, you paid well more than $10. And it's really, I'm making a kind of a silly example to make a point, but that's exactly what was happening. Everyone was focusing on the new monthly payment, the savings of 100, 200, $300 a month and most Americans, $300 a month is a free car payment. Like it's really life changing. But at what expense? You'll never pay off your home. And we didn't really elaborate on this, and I don't know if you want to get into it now, but talking about how to be financially independent, hindsight's 2020. But if I had one thing to do over, I would put away money from the first job I ever got at 16 years old, and I probably would never refinance because my goal would be to pay off a house. So if every American pays off their first house, they will be financially independent, and that house can continue to buy them other houses. It's an amazing thing that no one teaches you. It
Yeah.
really is. It really is.
Yeah. And it's interesting. I sometimes go back and forth with that, because on one hand I do agree with you, but with interest rates, like if you got an interest rate of 2.75, the there's also those the emotion that comes along with debt. Some people just have this. On one hand, you have people who like really hate debt and just can't stand it, and they want to pay it no matter what. And there are other people who like appreciate the idea of arbitrage, and using that to their advantage. And then there's everything in between. So as an advisor, I'm tempted to look at the math and say, hey, you're on one hand, you're 2.75 on your for your mortgage interest rate, and you're probably going to earn more than that over the same
Right.
period of time in the market. But if the interest rate is closer to 6.5, the conversation becomes completely different,
Right.
because the arbitrage isn't necessarily there and it's not necessarily worth it. But it goes back to our point about emotion. And I do think that there is, obviously, if you can own your house, to me it's about values. I sometimes I see people like they can see what it would look like to actually own their house outright, and it's just like something that's so important to them. At that point, I'm not going to try to drive arbitrage down their throat. I'll explain it to them and say, hey, look, this is because it's my duty to kind of show them, hey, you might actually end up with more money in the long run if you do it this way. But it's a hard thing, the conversations we're
Yeah.
having, because there's like, you know, me and you might think that way, and I totally agree with you. But there are, it's trying to make the emotion meet the math is always a
Right.
hard thing,
That's
not
a
just from buying the house. And
That's a good way to explain it, making the emotion meet the math. But by the way, you and I are saying the same thing, and I don't think I articulated it correctly. If your interest rate is 3%, and if you invest your money, you get paid 4, 5, 6, 8, 10%. I'm not saying you should be putting your extra discretionary income to pay off your house. What I am saying is paying off your house should be a goal, and don't refinance unless you feel it's utterly important. So sit down with a financial advisor like you buy a house. That 30-year term, I would say, with few exceptions, don't touch it. I'm not saying put any extra money because you're right. If you have a low interest rate, it's math, it's not opinion. Any extra discretionary income should be invested where you're kind of guaranteed returns of 4, 5, 6% instead of your 3%. But going back to refinancing, people keep resetting their clocks and never reach the 30-year period. And if you're going to refinance, if you always do it for rate and term, you'll be fine. So at the time when you're 6.5% and now they go to 100% you should refinance. But how many years you have left? If the answer is 22, then that new mortgage better be 20 years, which you get a lower interest rate than the 30-year, right? If you have 28 years left, then maybe get a 25. Don't increase your years. If you do that and supplement that with any discretionary income on top of that, gets invested correctly with a professional financial advisor, that's kind of all it takes for the average American to be financially independent and to never look back and never worry about retirement. But we don't do that because we're a nation of immediate gratification. And all we have to do is just kind of convince ourselves and trust in the math that look, if I start at 16, 17, 20 years old even and just start putting away, and when I buy my first house, I don't rush people to buy a first house. All I say is when you think you're ready and you do it, don't touch that mortgage. Don't touch it. And on top of it, you really should get a 15-year mortgage because it'll just force you to pay a little extra. People think that a 15-year mortgage is double the payment of a 30, and it's not. Your payment on a 30 might be 2,500. Your payment on a 15 might be 2,800, like $300 more. Not that that's an easy pill to swallow for some, but you're cutting off 15 years of payments, 15 years of interest. So there's a lot of things that I think are tried and true that no one teaches you. And it's kind of a shame. And Americans suffer and we kind of work way too hard most of our lives and struggle through retirement for no reason.
Yeah. No, that's great advice. I mean, as I sit here and listen to you, like in a lot of ways, what we do in helping clients is the same,
Right.
and to have someone that they can trust and work them through these things, is important. And I always say, if someone says to me, I think the biggest my biggest competition is not necessarily other advisors. It's people's delay or just
Right.
deciding not to actually ever work with an advisor, and find that person that can kind of help you through these things. Not that you shouldn't trust people, but I think it is important to find that person that you do trust. And I think that it's no different in working with a real estate agent. Like I feel like you should not necessarily just pick your brother-in-law because he's been in the business,
Right.
but obviously that can be helpful because if you trust them. But I think just go out there, meet a few people, find somebody that you truly do trust, has a great track record, because I think there are a lot of important things that are involved. And Mike, you're a longtime friend of mine, and I consider you're one of those people. And I would have no problem. Obviously, I've sent some people to you in the past, and
Yeah.
with that said, like how can people find you? What's the easiest way, or is there a place where you?
Uh, yeah, I'm a Remax agent. Realtors, I think, are the most accessible industry in the world. We have our cell phones all over, social media. You could just Google our names and we come up. But I'm located right in Denville, New Jersey. I handle basically all of Morris County, and I handle parts of Essex and Union because we're on the borders of all that stuff. But it would be great if anyone wants to sit down. And I hope if you listen to this podcast that there's a lot more to being a very valuable real estate agent than opening a door and saying, and this is your living room, not to be confused with the family room, right? Anyone could do that.
And look
You
at
want to
that
talk,
view.
yeah, yeah, yeah. And you got to buy now because it's only going to go up. I mean, at that point we're no different than a car salesman, right? And you got to get the undercarriage, rust proof spray. You don't want that. What are you guys looking to achieve? And you and I are friends outside of business, but in a way, it's not outside of business. We're friends because we align, our values align, and you do the same with
Mm.
your financial clients. Let's look at where we can get you. Where do you need to be? And we'll figure out the right path. Unfortunately, people in real estate or people looking for a realtor don't realize how much a good realtor can do for them. We don't just open up doors. We could really carve out a map for you.
I agree 100%. And before I let you go, like we actually have our past is connected. Really, we connected through running
Yeah.
first. I mean, I have to say, right?
Yeah.
And Mike just completed his first Ironman. Congratulations on that. That was
Thank
exciting
you so
stuff.
much. And you were
Yeah.
instrumental in all that. You got me to have a love for running and you helped coach me through my first marathon. And it feels like so long ago. And it's an amazing accomplishment. Thank you for acknowledging it because I had a long journey and things didn't always go right for me
Did you
health
sign?
wise.
I know we won't go into that, but
Right, right, right.
it was
But
a
thank
learning
you.
experience. But do you have anything else lined up? Do you have anything, or are you one and done? Get the tattoo
Well,
and call it a day.
yeah, yeah. I never will never say never. We talked about that on a podcast. No, I'm not one and done, but I am enjoying not having a crazy training regimen. So I did the Ironman, and then I immediately did the New York City Marathon, which I wasn't sure if that was smart. In hindsight, it turned out to be the best thing I ever did. I ran faster than I've ever run. It was my most exciting race, but I missed Boston by 4 minutes. And because you're a runner, 4 minutes is a lot. It's not as close as people think. But now I have a little bug to get back out there and do another marathon to qualify for Boston. I
Yeah,
don't think I'm in a rush to do an Ironman per se. Not that I wouldn't, but I'm not in a
yeah,
rush to do it. I've been there, done that, but I want to do Boston.
yeah. I mean, 4 minutes at New York City is not a lot of time because New York City is, well, not to go into details to bore our guests who aren't interested in
Right,
running, but
right.
you're right in the thick of things. So we look forward to looking to having you back on and seeing how that goes and seeing your progress. Well, Mike, you're a great guest. This is the we unpacked a lot here.
Yeah.
Please reach out to Mike if you have any other questions, or of course me if you have any other questions that we didn't address here. But thanks, Mike. Thanks for joining me.
Thanks for having me. Love to be back.
Yeah, yeah, for sure. But definitely. Look forward to I guess seeing how this housing market is going, where it's going to go, and maybe we can come back and be like, hey, remember we had that podcast and we said it
Yeah.
was going to do
And we'll look
this,
like
but
geniuses. Yeah. Well,
yeah.
if you can, you have all my contact information. If you can include it where you post the podcast. So if people do have
Everything will be in the
questions,
show notes for sure,
that would be
along with your
great.
smiling face. That's the.
All right.
All
Excellent.
right. Well,
Thank you, John.
yeah, you got it, man. And thanks everyone for joining us. Until next time, I will see you soon.